Hello, everybody. Um, Let me see if I'm live. Uh, am I live? I don't think I'm live. Hold on. I don't see it. Hmm. I don't really see my live stream. That's interesting. I think I am streaming though. Uh, okay. That's interesting. Oh, I see it. I don't really see my live stream. That's interesting. I think I am streaming though. Okay, perfect. Okay. What I'm here to do today is talk about economics. Generally speaking, I'm not an econ major. I have I haven't taken many econ classes beyond the basic high school economics classes. But I think finance is quite interesting, and I don't think a lot of things are taught in school unless you're like a econ major. Full disclosure, I'm a computer science major. I have nothing to do with economics. I just learned a lot of it myself, and I think it's really interesting. And in the future, I might try working on the intersection of technology and finance or whatever. Um, but I just think economics as a whole and finance as a whole is quite interesting. So I just want to talk about my understanding of how I understand economics as a whole. And I'm just gonna go on like a freestyle kind of rant kind of thing. I have some like overall topics I've prepared for, but nothing uh, specific. And I'm gonna go off on tangents and stuff like that based on everything that I've learned up to this point. Um, and it all starts with obviously. So I mean, yeah, I guess we can just get right into it. Um, yeah. Also, one more thing. I'm drawing with my mouse, so if my handwriting is a little, not good, I don't know, forgive me or something. Anyways, um, yeah. Okay. So let's start. Um, the core premise of economics. I've taken a few classes in high school and stuff like that, and they don't exactly start with the purpose of why a financial market exists. What's the purpose of like um of exchange, trading, money, all these things. I think that's a very key thing to start off with. So what are we like in this is how I understand economics. And obviously, I'm sure like a PhD professor might say this is completely wrong or whatever, but this is just my understanding. If you guys disagree, you could talk about it in the comments. Anyways, okay. So my basis for what economics is just talking about money, this thing right here, and but 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 it starts off with this question of what is this thing, right? What is money itself? Um, and that sparks a very interesting thing when I, went down this rabbit hole. Obviously, I think a lot of people do at some point in their lives. What what is this? What is a dollar? How does it work? And uh, to understand this, I'm gonna go in a little bit of a, I don't remember all of this off the top of my head, so I'm gonna be searching for stuff as I go along when I don't remember. Um, but yeah, let's start off with currency. So, what is the purpose of a dollar? That was unintended. Okay, so what is the purpose of money? So let's start off with that. Um, This is my first tangent, I guess. So we all know this is the central bank. The central bank sort of, I guess, if most Americans and stuff like that, they don't like this, but central bank, quote unquote, prints money. We're going to be talking about all of that. How, like, we have a lot of topics here, but we'll go through all of them. This is going to be a long stream, so if you're really interested in what I'm talking about, sit back, relax, enjoy it, whatever. Um, yeah, okay. So let's start off with this. What is the purpose of money, right? So money, from a traditional economic standpoint, is MOE, which is medium of exchange. I believe store of value, and unit of account. Okay. So obviously this is a little bit of a tangent, but we talk about cryptocurrencies, but Bitcoin itself doesn't satisfy the money these constraints. Um, it is a store of value. This is the best thing that Bitcoin is, right? So this is check. Is it a medium of exchange? It can be if you live in some sort of closed loop economy. It's possible, but it's not really good at this. So I would say like half-half, yes and no. And for the unit of account, it's just completely not a unit of account because it fluctuates a little bit too much. It's too volatile, stuff like that. So it's just not a good replacement for a for the dollar. And why is that? This is known as Gresham's law. Again, this is a tangent. If you're not interested, obviously you could like forward or whatever. So Gresham's law basically says that I believe bad money drives out good money. Let me just make sure I'm getting it correctly. Um, it states that yeah, bad money drives out good. So bad money drives out good. What this means is, if you see, and the simple analogy to this is, if you see like a crisp new $20 note, and you see like a battered, very like old $20 note, which one are you gonna spend first? It's probably gonna be the battered one. You want to keep the crisp new $20 note with you. You don't want to give that away. Similarly, the U.S. dollar is the bad one technically in this example because the U.S. dollar inflates. It's not exactly good money. In the sense that Bitcoin is that there's only 21 million in supply. The supply is constrained, which means it's sort of good money, which means that you want to hold that. You don't want to sell it, right? So you want to keep it with you. So that's why people use USD. That's one reason, but obviously another reason is that you have to pay taxes in dollars, right? So at the end of the day, when everything's said and done, when you pay your taxes to the IRS, they will collect it in dollars. So that's important as to why something like Bitcoin cannot be used as money. Again, this is completely a tangent. So I'm going to be doing a lot of this, but let's just go back to the original point. Yeah, what is money? Unit of exchange, store of value, unit of account. Okay. Historically speaking, money was I'm sure you guys have heard of this, but money was gold, right? Money was gold. uh, the core premise is that you don't want to trade. Like when let's just say I have apples and I want fish, the person might not want apples, right? They might want oranges. So I have to go to the orange trader, trade my apples for oranges, and then give the oranges to this guy to get fish, right? So this is like a very inefficient process. So we have to create something that we all believe is valuable, and gold through natural means is what people thought was value, right? So gold is it was used as a sort of a mediums of exchange and a store of value, but it was kind of bad as a unit of account. Basically, you cannot carry around gold. It's hard to like keep gold um, in like it's hard to like carry it around basically, and it might get stolen. There's all these things that you need to be aware of, right? And there was this really interesting historical thing. I'm just gonna search this up real quick. I believe uh, I heard that like when money was first invented as a concept, um, people thought that this was like the end of a moral, communal, and virtuous society. Especially like Aristotle and like Plato, they saw the shift from bartering as a dangerous to like the monetary economy is like a dangerous transition. Um, and I think this was when coined money, was first introduced, and they thought this was like a sort of like uh, it was not a so generally when you trade, it's a means to an end, right? You're trading for necessity, right? You trade because you want fish, or you trade because you want something. But money is hoarding money for its own sake is sort of unnatural and sort of immoral. This is how Aristotle sort of viewed it, and he also deeply condemned usury, which is charging interest, and it should not breed more money, whatever. So these are some like interesting things that when money first came around, like but right now we're in these like quote unquote like revolutionary times with like AI and everything, and like people back then, when money first became a concept, they saw this as their AI. They saw this as like a revolutionary thing that would change society forever, and it did. They were right. It completely changed everything in the way we operate. And some people argue it's good, some people argue it's bad, but undeniably, a lot of our technological progress is because of money. So it's something that we need to understand very deeply, in my opinion. So yeah, let's move on. Okay, so gold. So here's what I'll say, right? So let's just say you're, let's put ourselves in a situation. You're carrying around gold. You give it for, you use gold to buy fish. You use gold to buy this. You use. Oh, can you hear me? Okay, perfect. Yeah, you're like, you think this is really annoying. Like I have to carry around this gold everywhere. It's like heavy and stuff like that. And you just want to like, you don't like that. So here's what I say, right? I say, um, here's what I say. I say I'll make a deal with you, right? You can come to this little house thingy. You give me your gold bars. Assume these are gold bars. I really can't draw gold and stuff, right? So this is you. Okay, this is me. It's my gold chain. I'm kidding. Anyways, you give me your gold, and I give you. What do I give you? I give you this note, a token, right? This is a note. Might have a person's face on this, right? And I say, for each gold thing you give me, I'll give you a token, and anytime you can come back to me and you can give me this token, and I'll give you back the gold. Very simple, right? So what does that do? So this is the idea of a bank, or the first bank, a primitive bank. Obviously, banks have matured and changed completely, but this is the idea of a bank, right? And this is a banknote, right? So what does this mean? You could take my banknote, you could take this, and you could go to another person, right? And he's selling like fish. By the way, I cannot draw, but I'm going to try to draw. Like he's selling this fish, right? You give him this banknote, and he's going to be like, okay, well, this banknote is good because like I could just go to this guy, which is me, right? And because he gives me the banknote, I'll just give him the gold back. So he thinks, okay, this is calm. This is basically the same thing as gold. So he's fine with it. This is a banknote. Okay, everything good till now. uh, so banknote. That's the idea of a bank. Now here's the problem though. My competitor, he's my op basically. My competitor. So this is my bank is Bank A, and this is Bank B. Bank B is like another guy, right? And he's like, I don't know, he's like another dude, right? But this guy, he keeps all his gold in Bank B, right? This is Bank B. So so he gets this note, and this note is from Bank A, right? He gets his note from another guy, and he goes to Bank B, and then he's like, "Yo, I need this gold," right? Obviously, Bank B is not going to be able to get that, right? So he has to basically go to Bank A, ask for the gold, and then get it, right? You can see how that system basically becomes really fragile because a person who's banking with Bank B is not gonna accept money from a guy who's banking with Bank A because it's just like harder to deal with, and there's no inter lending and stuff like that. There's some complications here, right? Or this is my understanding. Um, Might be a little flawed, but whatever. This is kind of how I understand it. Um, so this is like the first idea of like cash, a bank note. But the main issue, there's a number of issues with this though. People obviously lend money and stuff, and lending, just to like have some terms. which most people, might not know. We're gonna have some terms here. Um, underwriting. Underwriting is basically just assessing. This is my own definition. I don't think this is the correct definition, but the way I understand it is it's just assessing risk. Um, let me just make sure that's correct. Okay. So, yeah, this is how I understand it. Underwriting is just assessing risk. Basically, like if I want to give out a loan, I need to assess the credit worthiness of the person I'm giving the loan to. So I need to assess the risk of that person, which means I am underwriting that loan. Yeah, that's all. So this system is a bunch of regional banks that hand out their own banknotes, and they have this gold as deposits, and they might lend out um, banknotes based on the collateral that they have. So, like this bank has some gold right here. And this is what we call like the assets of the bank. And they would lend out a bunch of banknotes. These banknotes, it would say this person basically wants a loan. He says, "Give me loan." Right? And it basically says, "Okay, I'll give you a loan. Here's your loan. This is like, let's just say there's a wad of cash, right? And that wad of cash represents like a percentage in this gold, right? And I think you are super credit worthy, so I'm going to give you this loan, but it's secured right here. So this is secured lending. This money is secured basically to this, right? So um, obviously there's a problem if like he asked for the money as well, and then he asked if they all ask for the money at the same time, it's what we call that a bank run. Everyone knows this, um, etc. etc. So these are the evolution of private banks, and they usually don't. In the past, they didn't work out very well because a lot of banks went under. They wouldn't underwrite properly. This is one of those situations. Like I don't really understand if this is true or not. This is kind of this is my understanding. So obviously, if anyone thinks who's like an actual economist who can explain it in the comments, maybe you know go ahead and do that. But from what I understand, private banks were just fucking like they were just terrible. Like I don't understand how they were terrible. Like usually private companies are just really good at underwriting risk, but apparently banks would go under all the time. Um, which is yeah, which is interesting. Like banks would need like bailouts and stuff. Like when they go under, people get very angry, stuff like that. This is what happened in the past. So this is kind of the mental model that I want you to have, and we can use this to move on to our kind of first topic, which is central banking. Uh, the modern central banking system uh, does not have is not backed by gold. I think we all know this, or most people know this. I'm not sure if people who know nothing about finance know this, but usually this is what we call the gold standard, right? Basically saying, I believe like it was like 1 USD equals like 10 ounces of gold or something along these lines, right? And basically, this is the gold standard that people talk about. And in 1971, I've heard this phrase a million times in all sort of economics communities, but in 1971, Nixon, President Nixon, came off the gold standard. He basically forced, or not forced, like he basically made the central banks come, or the U.S. bank come off of the gold standard. Makes or breaks, I'll just say breaks gold standard, whatever. It's like not exactly, but whatever. Um, so a number of things here. Um, first off, something that we need to understand is this is some context that is necessary. This is post World War II. Obviously, we know this in history and stuff. But the U.S. came out as a superpower post World War II. All other countries were basically out of communism, or they were out of, or they were, they had huge war debts, or they, whatever. So basically, the U.S. was the only country that was a sort of stable lender. They were the only person like country that was creditworthy. So there was this concept of the Bretton Woods Agreement, which basically which from my understanding is like, I let me just make sure I get this right because I don't want to like hallucinate stuff. Okay, yeah. So basically, TLDR, 44 nations pegged their currency to USD, right? Ignore the handwriting. I'm not trying to become a doctor. Anyways, uh, 30. Okay, never mind. It was $35 per ounce. Never mind. This $1 10 ounces is just. I guess this is BS. $35 per ounce. Okay, so what does this mean? Basically, what happened was 44 nations agreed that their currency is going to be pegged to the US dollar, and the US dollar is going to be pegged by gold. And what that means is $35, 35 US dollars is going to be 1 ounce of gold. And this is for like trade stability and like competitive value, whatever. These were all these things, right? And this is a system that all the countries, all the nations came to agreement on post World War II. And uh, yeah, so sort of like after this, right? So just think about this for a second, right? I let's go back to my bank analogy for a second. I think that would make more sense, right? Which explains how I view economics, which is just really, I just view this as really interesting because a lot of counterintuitive things happen all the time. Um, let's just say Bank A or Bank B. Okay, Bank B. This guy is banking with Bank B, right? And he shoots, or let's just say Bank A for now, because there's some notes here. So this note, what did I say in the beginning? I said this note would be worth whatever gold you have. So let's just say this note is worth 10 ounces of gold, hypothetically. And this is the guy, right? He has this note, right? What if one day he comes back to me and he hands me back the note, right? And he's like, yo, give me 10 ounces of gold. And I say, what if I just say, no? What if I just say no? What if I say, no, I'm not going to give you the 10 ounces of gold? Like, what happens then? Well, that's kind of what happened. Kind of, not exactly. This is how I view it, but this is kind of what happened in 1971. Nixon basically said, we're going off the gold standard, which basically means that the US dollar is no longer pegged. By the way, this is completely wrong, but whatever. It's this. Uh, the $35 is no longer 1 ounce of gold. It's just gonna, it's just gonna free float in the economy. It's not backed by anything. It's not backed by, it's not backed by anything, right? So what does that mean? So you might be like, yo, wait, what? Like it's not backed by anything? Like, aren't these like notes pieces of paper? Aren't they useless? And that's where you would be wrong. If I can do this, if I can, USD market before right before 1971 and right after. If I could do this, I think it would be really interesting to show you what actually happened. These were as index. 1 second. This would be. There we go. So. Where is it? I guess I can't. I guess I can't really find it, but whatever. The basic idea is, you would think that basically everyone would just like tear up the pieces of paper and go home, right? Because the government just defaulted on its credit. Like that's basically what happened. But that's not what happened. You know, the dollar actually kind of strengthened. Not exactly strengthened, but like the liquidity and everything. Nothing happened basically. And this is our current
You don't really need
the sort of world we. Sorry about that. This is the kind of world we sort of
Amalgamation of 500.
live in now. And this is what we call the fiat currency, right? This is a fiat money, right? This is fiat money. What is fiat money? Central banks print fiat money. And what is it backed by? It's backed by the full faith and credit of the US government. What does that mean? Now, that just seems kind of like wishy washy. What does that even mean, right? Here's what that means. It just and this kind of puts into perspective. The U.S. As a country is more quote unquote valuable than gold, essentially, right? Kind of. This is how I view it. When you say it's backed by the U.S., essentially what you're saying is the taxes that the U.S. collects on its people, the revenues it gets from whatever trade and everything, tariffs, whatever, like whatever's happening. We basically back the dollar off of that, off of our GDP, off of our sort of taxes and productivity and everything, right? So that's what that means exactly. It's backed by the US, but it's no longer backed by a hard asset, right? So you might be thinking like, how is it backed? Like, how does the backing quote unquote work? How does this money like when is it printed? How does it work? Like, all these questions. And so that will lead us to central banks, right? So from what I understand, there's like a two. Obviously, if I keep going like this, I think this is gonna take forever for me to explain all this. But I'll speed up. From what I understand, there's a two-way system. First of all, there's a two-tier system that's completely different. There's the Treasury, the U.S. Treasury, and we have our as a side note, there's the U.S. Treasury. Um, as a quick side note, our Treasury Secretary Scott Bessent right now. This is 2026. Um, he's a very interesting guy. If you know anything about Scott Bessent, uh, I think he's a very interesting guy. He actually uh, there's a lot of conspiracy surrounding him. Obviously, not surrounding him. He actually worked at I believe Quantum. What's it called again? Quantum Management Fund. Let me just search that up. The Quantum Fund, right? This is the Quantum Fund and Source Fund Management. So he worked with this guy George Soros, who is a source of a lot of controversies and stuff like that. I'm not trying to get into that. But he's credited with sort of making huge amounts of money when the Bank of England basically default or not defaulted, but basically I guess they defaulted sort of. So yeah, very interesting guy. You should go read about him and uh, and how they pegged to the I believe it was the Sterling or something. I don't really know. It's like basically the Berlin Wall fell, and then post Berlin, post that incident, they believed that it would actually devalue, but it didn't. Whatever. You can go read about that. I think it's quite interesting. So we have the U.S. Treasury, and we have the central bank, which is the Fed, right? If you've ever heard Jerome Powell which is our secretary, sorry, what is it? Fed chair? Yeah, he's our Fed chair. You would have heard of the dual mandate. And the dual mandate is basically this thing right here. We'll talk about that. I'm not going to draw anymore because I'm getting tired. I'm just going to speak. The dual mandate. What is the dual mandate? The dual mandate is that is maximum employment, so low unemployment, and low inflation. So they usually have a 2% inflation target, from what I understand. And they want to have maximum employment. This is sort of their dual mandate, right? So what does that really mean? Like, how do they really achieve all that? I think that's an interesting question. So here's what they do, right? And this really before I mean, so we're going to talk about the dual mandate and how the sort of Fed achieves this. Um, yeah, I just want to make sure everyone keeps track. I just realized that like people are watching, this might be even more confusing, but it might interest you to like learn yourself or whatever. But yeah, let's just talk about this. So dual mandate. How does the Fed do this? Before to understand this, we need to talk about supply and demand. It's a very core key concept. If there are five apples, pretend this is an apple. Can I like do some like crazy copy paste and stuff? Like, oh, delete that. That's not what I wanted to do. Copy this. Okay, we have these four apples. These are apples, by the way. Apples, right? And sort of, let's just say each apple is worth $1, and there's like $4 in. What am I drawing? There's like $4 in circulation. Okay, so assume there's like $4 here. Uh, right? So you would say like each apple is sort of worth $1. Okay, if I could if this could work, it would be really nice. Why is this not working? There we go. Okay, so you would say each apple is worth $1. But what if like somehow, and we will discuss this, what if they basically start printing more of these dollars? So now there's not $4 in circulation, it's $5 somehow. Or there's $10, or there's $50, or there's $100, right? What does that really mean? The truth is, no matter what the central bank does to this thing, if they can adjust the supply of money how much ever they want, but they cannot adjust the supply of actual goods and services, right? At the end of the day, like in a real economy, in terms of productivity, in terms of labor growth, in terms of like actual hard things like food, housing, all these things, they can't really do anything about that, right? But they can adjust the money, right? So even if you print more money, what does that do? That just makes apples worth more. So instead of one apple being $1, apples will be worth $2 because there's more money. Everyone has money. And this is like a great analogy that you should probably think of. I'm not even sure if this is exactly true, but like, um, if you just went, let's just say like a billionaire just goes and gives uh, sort of like, let's just say he goes to some place in uh, some rural area and just gives that rural community. He just gives everyone like $50,000 in that community, and they can't leave that community, right? The goods and services that are accessible in that community has not really changed, right? That community may have only 10 apples, right? So some billionaire giving you $50,000. Obviously, this is because we live in a global economy, demand is insatiable, supply is insatiable, whatever. So there's all these complications. But in general, in a closed economy, if the supply hasn't changed, right? The supply of goods and services hasn't really changed, but you just give more money, that doesn't really do anything, right? The prices of goods just go up. And this is what we call inflation. This is inflation, right? So you would think a person who's logical would think, how can the Fed, by printing money, do anything to solve employment? We thought goods and services are low. How could they do that? And 2% inflation. Like sure, if they like if they don't so where does that 2% inflation come from? Like these questions, they're great questions. So a lot of people say, the money they print juices the economy, temporarily bumps the economy. I mean, how could it bump the economy if goods and services are the same, right? And that's a great question, and and the answer to that is I mean, if you look at it in the negative light, it would be debt. If you look at it in the positive light, it would be lending. So, yeah. But again, these are. I don't think I have time to go over all of this. This is like it's already been like time, but like whatever. We'll just go through how much ever I can. So debt and lending. How does this really work? To understand this, I guess we have to now go through the two-tier system. What is the bank in the modern day? In the modern day, a bank is not this. It really isn't, right? This is not what a bank is anymore. Um, a bank in the modern day, it does still collect. I guess this is not. I can't draw. I just can't draw. Whatever. I'll just like find an image of like a bank, like a dollar, low dollar. Okay, very nice. I guess that's good enough. Let me just erase this abomination real quick. Um, okay, if I can bring this here. So, what does a bank do in the modern day? I think most people, what they understand is, uh, uh, people give deposits to a bank, and the bank lends it out, lends it out, right? So, like, let's just say a bank gets $1,000, right? It will keep, let's say, keeps $100 in for like a safety net, and then it lends out 900, right? So this is what people think a bank is, right? So the problem is, so this is like if you have like a balance sheet, like you have like assets and liabilities, um, to the bank. Obviously, it's from the bank's perspective, not your perspective. So please understand that from a bank's perspective, its asset is the are the loans, right? So these are the loans because every loan that the bank gives out must be repaid back with interest. So to the bank, that's an asset. For it, a liability would be a deposit because it needs to pay a yield on the deposit and needs to pay back the deposit to the people, right? So that's that. So those are like the balance sheet analysis, whatever. And people think, I put $1,000 in the bank. The bank basically takes $10 or $100, keeps it, and then it just lends out the 900. Now, well, that's kind of true, but it's not exactly how a bank works, right? For a number of reasons, um, which uh, which we will get into. First of all, a key distinction that you need to understand is a bank does not hold US dollars. Like, sorry, it does hold US dollars, but what you see, like when you go to your bank portal and you see five $5,000, that's not exactly US dollars. That's an IOU from the bank. I think that's a distinction that most people forget. But what you see on your screen is just like when you see like, oh, you have, it's not exactly how it is, but you have $5,000. This is an IOU from bank, right? This is IOU from bank. And again, this is gonna actually take me forever to explain all this, but whatever. We'll go through it. Um, so this is sort of true. And as a side note, this is called a reserve requirement, and this is set by the Fed, right? Reserve requirement 10%. Basically means that all banks must keep 10% of the deposits that they get in reserve for in cases of a bank run, right? That would be what the Fed says is a reserve requirement. Um, Also, as a side note, what do you guys think the reserve requirement for a bank is right now? It's actually 0%. And obviously, don't panic and whatever. Like this is uh, usually there's smart people doing this. The reason why there's 0% is that people just thought, uh, again, okay, I don't want to get into the tangents of this, but you could go search this up. It's mostly safe. It mostly makes sense. But you could search up why the reserve requirement right now is 0% and it has been for the past like I think 15 years or whatever, probably more. Whatever. So that's a side note. Um, uh, um, yeah. I totally forgot to mention this, but 2% inflation. This is so. Let's go back to the dual mandate. They have to have 2% inflation. Actually, it's not actually a dual mandate. There's also like a third, which is like stable currency. Uh, but this is like on the back foot, not really like their primary priority. But I guess it is sort of like not exactly. Whatever. 2% inflation, maximum employment. How do they do this? They have three levers to basically do this. Their three levers are, if I can remember, um, uh, I think this is going to be interest rates. Uh, Then we have, I believe, reserve requirement, and then we have QE, right? QE. So when we say like printing money and all these things, like what does that really mean? Like, like I know a lot of people online who like, conspiracy theorists, whatever. They don't really understand what like all these things work, and they just want, I don't, I'm not necessarily a proponent, or I'm not against it either, but I'm not necessarily a proponent of it. But I'm just saying like I feel like it's interesting to learn about all these things. So let's just go over how these things work. Um, so the interest rates, reserve requirement, QE. Essentially, so what does that mean, right? Let's talk about interest rates. How does the central bank set an interest rate? And the answer to this is there's something called a Fed account. Okay, I don't know. I just feel like it's gonna get really, really complicated. And I'm just like going in circles, but whatever. I'll explain. What is the Fed account? Every single bank in the United States, which is certified, which has an FDIC insurance of 250,000, is gonna have a Fed account. What this means is they have like a Fed account is having an account at the Fed. So every single bank, Bank of America, J.P. Morgan, all of them have an account at the Fed where they basically have money stored. And a crucial thing that you need to understand is the money at the Fed account never leaves the Fed account. It never goes outside. It only goes within banks. Okay. But what that means is and this is the two-tiered system which I'm talking about. Basically, how it works is central bank, commercial banks, non-banks. So this is like you, me, other people, right? Commercial banks, central banks, central banks, commercial banks, non-banks. Uh, so just like how I go to you, sorry, just like how we go to a commercial bank and we have an account at a commercial bank, the commercial bank has an account at the central bank. They have a Fed account, and in the Fed account, they basically uh, uh, they they have so if they hold money, um, so you might be asking like, why do they have a Fed account? Um, Maybe you bank with Bank A, right? Another person banks with Bank B, right? Bank A, Bank B, right? This is Bank B, Bank A, sorry. And then I bank with Bank B, you bank with Bank A, and I want to send you $100, right? Um, what you need to understand is the $100, if I give it to you in person, like let's just say I pull out $100 note and I just give it to you, right? That's real cash. That's money. But in a bank, what did I say before? A bank is not real cash, it's an IOU. Now, it functions as cash because it's insured by the government. FDIC insures 250,000. And they're also a lender of last resort, which basically means that any assets that the bank has can be sold at the discount window at the Fed. Um, Obviously, this is like a very like uh, looked down upon thing for a commercial bank and potentially bank ending, whatever. But they still have the backing of the central bank, um, discount window, whatever. So um, it functions like money, but it's not money. It functions like it because it's liquid, whatever. So if I, as a person in Bank A, want to send money to a person in Bank B, um, I would go into my bank account and I would be like, send this person who banks with JP Morgan $5,000. What does Bank B do? I'm Bank B, I want to send a Bank A. What does Bank B do to send that money over? Do they like go pick out $5,000 from my account and go to Bank A and then like it's like, hey, here, I handed it to you. Like, what do they do exactly? How does that work? They go to the Fed account. They basically say they go to the Fed account and they say, "Yo, Fed, I have money in my account at the Fed. Um, take some money off of my account and give it to Bank A, who also has a Fed account." Very simple. So they go to the Fed account. They say, "I have some money at the Fed account. Get that money and put it into Bank A." So this is like, think of this like as like a huge like office or something. I don't really know exactly how this works, but like or I guess I kind of do, but like think of it as like a huge office, and there's like piles and piles of money, right? There's like each room has money, and in each room it says Bank A, Bank B, Bank C, Bank D, right? And Bank B basically says, I want to send money to Bank A to the Fed. The Fed will go from Bank A's reserve. They'll open their vault, take money, and then give it to Bank, and then put it in Bank A's vault. Kind of, not exactly how it works, but obviously now they just type numbers in onto a screen, but whatever. Um, that's kind of how you would think about it. So this is a two-tiered structure, right? So if I want to send money from Bank B to Bank A, this is how that would work, and any other bank for that matter, right? Great. Um, okay, where were we? We're talking about the dual mandate. Okay, so let's talk about lending. Now, this is how banks work. This is the Fed account. Really quickly, the Fed functions as a lender of last resort. This is a very important concept. A lender of last resort basically, it kind of means like a lender. I would say like bailer of last resort. Basically, they bail you out if no one wants to bail you out, type thing. Kind of, not exactly. Like it's basically bailing out with no moral hazard. Uh, Bailing out with no moral hazard. Kind of. Again, this is how I think it works. I'm not like again, I'm not an economist, not a finance guy, like a computer science guy, but like whatever. So this is just how I think about it. So this is a lender of last resort, but they bail out without basically having a moral hazard because they sell assets at a discount window. What that really means is, let's just say these are the assets and liabilities of a bank, and a bank, like I said, they keep a reserve and then they lend out everything else, right? But what if everyone comes back and they want the money? Then a bank runs into something people call a liquidity crunch. Um, it runs into a liquidity crunch basically because it has to sell all of its assets, which are its loans, uh, to get real dollars, right? It needs to sell all these assets quickly to get real dollars so it can pay out all the people who are asking for money, right? And usually they first go to other banks, right? And other banks are usually very like okay, these are like the smartest people on Wall Street. They're like, they're like hawks. They know how these things work out. So like at the end of the day, if you like, let's just give you an example, right? Someone's struggling out there and they basically have to meet this liquidity requirement and they're struggling. You could basically undercut them hella. Like you could just be like, oh, like these assets could be worth $1,000, but you could say I'm only giving you 900 because I know you're a liquidity crunch, right? These are the kind of things that banks do, and all those things. Very interesting. But if no bank wants to give money for these assets, the Fed acts as the lender of last resort. They basically buy up these assets. Obviously, these assets have to be good. They cannot be toxic assets. If they are toxic assets, that would be a bailout. That's exactly what happened in 2008. All the credit default swaps basically. The CDSs basically were a showcase of how um, of how many banks were defaulting, or yeah, like the default rates rising significantly, which caused this liquidity crunch, and banks had to like sell their assets and stuff. But their assets were filled with, I believe, mortgage-backed securities, which were kind of toxic because basically, like the mortgages inside them had like ninja loans and stuff like that. So basically, they had to like these were like toxic assets, and there's no chance that the people are going to pay them back. Whatever. So even then, the Fed basically bailed them out, and they bought up all these assets, even though they were definitely toxic and they were not worth anything. But whatever. That's a completely separate topic. Um, so yeah, this is asset liabilities. Okay, cool. So that's the lender of last resort. Uh, and then uh, what do we talk about? Dual mandate. Okay, now let's talk about lending. Okay, in the modern day, a bank does not wait for deposits, right? It does not wait for this. It just goes ahead and lends money. It can raise a bit of money, which is equity, like it has a little bit of equity. But let's just say someone like it has no deposit, it can have zero deposits. A person comes in and they say, "I want $1,000 loan." The bank can literally just go in and write $1,000 on your account. They can just do that, and that's the power of crediting money or money creation. I think I didn't explain this properly yet. But the main goal, what is the purpose of a bank? I keep forgetting about purpose and stuff like that, because I'm trying to explain all these things. But I think it's really important to talk about the purpose of these things and why these things exist and why they're important. The bank's fundamental reason to exist and why it's useful is because of the velocity of money, right? If I keep $1,000 in under my bed, that's bad. Why? Because I could be lending out that $1,000. That could be someone else's income, right? Because I lend that money out. Someone else could be using that money, and that could contribute to the economy. Except now, I'm not even doing that. I'm just keeping it under my bed. That's really bad for the economy, right? Um, economic sort of like economic um productivity and growth comes from capital formation and capital allocation, and lending is a very key and crucial role for that. When a company, let's just say a company needs $100,000, right? And this company is in the future going to give that back to you, obviously. And why do you know that? Because you've gone through a very strenuous and crucial process of what we call underwriting. You underwrite the risk of the company. This company, or you don't know for certain, but there's a risk, obviously, and you get a risk premium. Uh, Again, this is another term. Like, uh, if you think the risk is higher, if you think that this person is likely to default or they might default or something, you'd obviously charge. If they're definitely going to default, you don't give them money. Obviously, if you think they have a higher chance of defaulting compared to someone else, you charge them a higher interest rate. Obviously, historically, this is looked upon very badly. This is what they call usury. I don't know why I'm putting that here. I think everyone knows this. Uh, Charging high interest rates, but this is a very, you know, this is a very required thing in a capitalist system, because charging high interest rates is just a representation of the fact that you are a high risk lender. The fact that like you might not return the money demands a risk premium in the short term. Anyways, let's going back to this. $1,000 under bed is bad because there could be a company that's trying to form right now who's creditworthy. They will probably give the money back, or they'll invest in very safe assets or whatever. But they are not getting that money because you just have it under your bed. That's bad for the economy. And a bank basically increases the velocity of money by allowing people to invest, or not invest, like basically giving people a yield on their money, and also increasing the velocity of money in the overall economy through the money multiplier effect, which basically means that this $1,000, I believe, I'm a little rusty on this, but if you put $1,000 in the bank, from what I understand, I think it's now $10,000. $10,000 in circulation in money supply. I think. Let me just search that up, just to be clear. Money multiplier effect. I think so. It's one over the. Oh God, it's one of the reserve ratio. Huh. That's actually an interesting question. What if there is no reserve ratio? Huh. Okay, that's interesting. Um, Usually the reserve requirement dictates the money multiplier effect. If the lower the reserves, the higher money creation can happen. But right now, since there's zero reserve requirement, technically it's undefined, which means that money multipliers like the mechanism is obsolete. Wow, that's interesting. Let me just read through that real quick. Without reserve requirement, banks will limit lending based on capital adequacy, profitability, and risk management rather than reserve limits. Wow, so they can just like lend out how much ever they want. Okay, uh, okay, more or less. because in bad economic times, it could be less than 10,000. In good economic times, it could be more than 10,000. Basically, a 10x. Let's just say 10x for a good number. Essentially, like whatever money you have, how does this work exactly? Like, let's just say $1,000. You put it in a bank. The bank lends out $900. 10%. It keeps $100 in the bank, right? It lends out 900, and that's a loan to someone else. That person uses that $900 and spends it. They spend it on I don't really know, Labubus. Who knows? Okay, they spent that money, right? Now the person, and they spent it, and the person who made the Labubus, now that's their income. They just made $900, and they deposit it in the bank, right? And then sort of after they deposit in the bank keeps 10% 10% behind, uh, and yeah, it keeps the 10% behind, and then loans the rest, which is $810, right? And it loans out the 810, and then that's someone else's loan, and then they take it and then they spend it on coffee or something, like whatever. They spend it on something, right? There's some big purchase, and then that becomes someone else's income, right? So this is a crucial thing. One man's a loan is someone else's income, right? A debt is someone else's income. Um, yeah. So velocity of money is really crucial for a growing economy, essentially. Um, and this is a great example of this, actually. Like this. I guess we can't really see it in this. Whatever. This is again, we're not going to talk about M2, M1, like M1, M2, M3 money supply and stuff. Like this is, I think it's a little boring. Like I mean, it's cool and all, but like it's not tough. You know what I mean? Like it's not all that. It's like interesting, but it's not required. Like I think these things are pretty interesting. But yeah, it's just like make it bigger. Okay, so that's that. Let's go back to the dual mandate. Okay. So so yeah. Why did I talk about that? Fed account. Fed account. Exactly. The Fed account. Why is the Fed account important? Right. When Bank B goes to the Fed account and it has some reserves there, this reserve is called IORB. I forgot what the full form is. Let me just search that up real quick. IORB, internal rate on reserve balances. Internal rate on reserve balances. Okay, internal rate of reserve balances basically means that this is the interest that the central bank gives to the regional commercial banks for the money that the commercial banks have in the central bank. Okay, similar to how when I deposit $1,000 into my commercial bank, I get like a 5% interest rate or something. Okay, obviously not 5%. Like let's say I get like a 1% interest rate or something, right? Similarly, when a commercial bank goes to a Fed bank and they put their money in the Fed account, they get an interest rate on that, and that interest rate is what the Fed controls, right? So you might be asking, how does this affect anything? The Fed, being the United States government, is essentially risk free, or like in the sense that they will not default on their loans. Like how you and I might, like, if I get a loan, right, I might default, right? Or if someone else gets a loan, they might default. But the US is seen as some entity that does not default. Now, obviously, this is not exactly true. Like, obviously, governments have defaulted before. Even the United States has been taken down from its AAA bond rating to like AA plus or something by the last company rating agency, Moody's. Whatever. These are things that, not really something uh, outside the scope, but generally speaking, you need to think of the United States government as a risk-free lender, or risk-free, essentially. So what that basically means is they set the floor interest rate. Okay, floor interest rate. What does that mean? If the United States basically says they'll give you 3% on the money that commercial banks put that they have in the Fed, they give 3%, right? Um, that what that basically means is, would you lend out uh, would you lend out money to anyone at an interest rate that's lower than 3%? That's the question you need to ask, right? If I'm a bank, I'm a commercial bank, right? I have two options in front of me. The Fed, so I have $1,000. I'm a commercial bank. I have $1,000, and I have two options. I could put this $1,000 in my Fed account, and the Fed will give me a 3% interest on my $1,000. Or I could put I could go to the Fed account. They give me 3%, $30, whatever. They give me that interest, right? Or I could lend out my $1,000 to a regular person who's, they're not risk free, but whatever. I can lend it out, and let's just say they're charging, and I can charge them 3%, right? What would I ever lend to a person at any rate lower than 3%, right? If a person would only come to me for a loan at 2% interest rate, why would I give that money to them? I could just go to the Fed account, park my money there, and I would get a 3% interest rate, right? So what the Fed does is they set the floor rate. Okay, so a commercial bank will look at the Fed and they basically say, okay, you're giving me a 3% yield. Any loans that I give from now has to be higher than 3%, to justify the risk. Because if the Fed, which is basically risk free, is giving me 3%, then you're definitely risky, then you should give me 4% for the risk I'm underwriting, right? So the Fed essentially sets the interest rate by setting the floor. And this is the internal rate on reserve balances. And this is one of their mechanism by which they set, by which they achieve their dual mandate. Internal rate on reserve balances. Interesting question that I will cover is, where does the Fed get this money from? Great question. We'll definitely talk about that, right? Okay, so that's that. And you might be asking now, like, how does lowering or increasing interest rates do anything to solve unemployment or inflation? And that's a great question. Here's what I'll tell you. Here's what you need to think about, right? What did I say just now about the velocity of money? One man's money, or one man's debt, or one man's loan, or one man's deposit is another man's income because of the banking system. When I put $1,000 in the bank, that turns to $10,000 in money supply because I put $1,000 in the bank, someone else loans that $1,000, they use that $1,000 to spend it on something else, and that spending becomes someone else's income, right? So what that basically means is when you lower interest rates, the money supply increases, right? And if the money supply increases, that means more people have more money, right? That's the thing. It increases the velocity of money, right? So when they decrease interest rates, what does that do? That is trying to address one mandate in their dual mandate, which is maximum employment. What does that basically mean? A business, let's just say Google, right? It sees that, let's just say it wants to build a new data center, right? But like, let's just say interest rates are 5% right now, and it's like, wow, that's expensive. That's just expensive. Like, I need to I need to get all this money, and then I need to pay a 5% interest, and then I can do this. That's expensive. But then the U.S. basically says, oh, we're dropping interest rates from 5 to 0. Now Google's basically like, oh, that's pretty good. I'm gonna take a loan of like 100 million, whatever, 1 billion. I'm gonna build these data centers, and these data centers, basically in the process of building it, they have to pay all these employees, and those people get employed, and that's maximum employment, right? So you could see how that juices the economy, right? You can see how that juices the economy. Because when you lower interest rates, more people borrow money, and more people borrowing money increases the velocity of money because one man's deposit is another man's income. One man's debt is another man's income, right? Cool. So that's how so when they lower interest rates, they will achieve their goal of maximum employment. But there is one problem though. Inflation, right? Go back to my analogy over here. Apples. If there are only 4 apples, no matter how much money or no matter how much money you put in the money supply, like how much you increase the money supply in the economy, there are still only four apples, and that will not change, right? So let's take a very simple analogy in the data center thing, which I talked about, COVID, right? In the example of COVID, if everyone is locked down inside their houses, right? No matter how much money you lend out, people just cannot open a restaurant. That's just the truth. People can't open a restaurant because it's COVID. Okay? People cannot do some things because it's COVID. People cannot build a data center because it's COVID. So no matter how much you print money, you can't do anything because there's only four apples, right? So um, what happens then? It causes inflation, right? It causes inflation because the price of existing goods increase. Unemployment does get slightly better, but the prices of existing goods goes up a lot, which causes inflation, right? So the Fed must engage in what we call quantitative tightening, or tightening in general, by increasing interest rates to basically decrease the money supply so that we could cut down on inflation, right? So that's the general idea. Okay, so that's one thing we talked about, which is interest rates. Now, what is quantitative easing? We already said that the reserve requirement is no longer in use. Reserve requirement is basically zero, and it's dictated by the creditworthiness. Like the banks basically dictate how much that they lend out to people because um, they basically dictate, like they just look at like the capital adequacy, and like if the person they're lending to is creditworthy and stuff like that. Whatever. So the reserve requirement is basically gone. But QE, this is like a conspiracy-esque term. What is QE, right? Quantitative easing. I'm trying to find a good image for this. uh, one sec. There's a very funny meme from this one podcast called Double Line by Jeffrey Gunlock. He's a billionaire bond investor, and I think is it's a very funny thing, which I definitely. Um, well, actually, I don't know if I want to post this online. Okay, never mind. Let me just post this one. This is pretty good. Can't find it. What the? Oh, there we go. What image do you have? Yeah, this is gonna be a very trash image, but whatever. I think you get the point. Boom. Printing money. QE. Quantitative. Quantitative. Wait. Quantitative easing. Okay. What is it? Right? How does it work? And that's very and this like like when they print money, how do they put money into the economy? Like I think it's a very natural question, which I don't see many people really asking, to be quite honest. Like, oh, they just print money. Print money how? How does this money enter the economy? How does it work? What are the mechanics? I don't think anyone asks these questions. But let's talk about this. Actually, do I even understand how this works fully? I think I do, but like we'll see. If anyone, any economists watching, let me just see if someone's watching my stream. I don't think anybody's watching, but let's see. See. Well, actually, do I even understand how? Seems like one person's watching. Whatever. I already know who that is, but okay, cool. Um, here's what I understand about quantitative easing, right? Uh, the Fed basically either for quantitative tightening, I believe they buy up. No. They sell treasuries, and for quantitative easing, they buy up treasuries, right? Okay. Let me just make sure that I get that. Okay, cool. So what is quantitative easing? All they do is actually I think we need to get a little side note on how this basically works. But the let's go back to the treasury, which is right here. This boy. The treasury has something called treasury securities. Securities, right? And these are bonds. You probably heard of this, you know, the yield curve, 10-year, 30-year, 55-year, whatever. I'm gonna get the yield curve just to like illustrate the idea. I need to draw less, man. I'm getting tired, but like whatever. Um, Generally speaking, this is gonna be what the yield curve looks like, sort of upward sloping, and then like kind of whatever. I'm gonna put this here. Okay, so this is gonna be the yield curve. Um, what this basically means is when you buy a US bond, the bond basically says, you know, in 5 years, I'm going to pay, or like for 5 years, I'm going to pay this yield. So, like over here, you see this like 10-year pays at 3%. So, um, what that basically means is if you buy a US treasury, a 10-year treasury T bond or bond, it will pay a 3% yield. Okay. Um, and that's that. That's basically how it works, right? You could go into the mechanics of it. Basically, if the price goes down, like the yield is basically set in stone, not set in stone, but like it's basically set already. So the yield curve or the yield is determined by the price of the contract itself. So the price of the contract goes up, you basically get less yield in percentage terms, and if the price of the contract goes down, you get more yield in percentage terms. So that's how the yield is determined, yield curve, whatever, right? Simple example is if I own, let's just say I own a 10-year treasury contract or what do they even call it? Is this a T-bond? Like what is it? What is this called? Uh, Whatever, 10-year treasury bond, I guess. Whatever. It's just the bond. If I own this bond, right, and it says, oh, I'm gonna pay you let's just say because you bought this bond at this time, because when I go out to buy it right now, it's gonna say like some rate, 3%. So when I go out to buy it, it's gonna say, oh, I'll pay you 3% right now. Let's just say that's like $50. Well, some example, right? That's I'm gonna pay you $50 for this bond. You hold it for 10 years, right? And I paid a certain number. If in the future yields go up or down or whatever, let's just say my bond becomes more valuable. So people are willing to pay more for my bond, which basically means that my bond is like the price of my bond went up. So I could sell my bond to someone else for like a higher price, the bond itself. So if I sell them to, let's just say like, oh, $5,000, right? Now the yield basically went up because the $50 that the yield promised to pay is still the same, but now the price went up, so the yield went up. Or sorry, the price went up, so the yield went down in percentage terms, whatever. So these are, yeah. Anyways, but quantitative easing in simple terms, basically all the U.S. does is it's going to buy up these treasury securities from the open market, and not it goes to the primary dealers first, and then the open market. I don't really think it does open market operations that much. Like it does do open. Okay, okay. I guess I'm getting a little confused here. There's something called OML, open market operations, right? This is basically the Fed going out and buying a bunch of treasuries and mortgage-backed securities to inject liquidity directly into the economy. What that basically means is, let's just say I own a 10-year treasury bond, right? The Fed themselves will come to me and say, I'll buy this treasury bond from you for this price, give it to me, right? And let's just say I sell it to the treasury, not to the treasury, to the Fed, right? The Fed will pay me with money, right? That money is printed, basically. They just type in to my bank account. They basically like credit it to me in my bank account. Like let's say, obviously, okay, they do it with a primary dealer, so it's not exactly like they don't do this with non-banks. So let's just say I'm J.P. Morgan, okay? I'm J.P. Morgan. I have like a bunch of treasury securities. right? When the Fed carries out its open market operations, they basically go to let's just say they go to like all these banks and stuff, and one of them is JP Morgan, and they'll basically buy up the security from them, and they will give them money, but they will just give them money in their Fed account because they have a Fed account. They'll just add numbers in that Fed account. So, like, let's just say they bought $50,000 worth of treasuries from JP Morgan. Well, they'll just add 50,000 to their Fed account. And where did that 50,000 come from? Nowhere. They just printed it. That's really just it, right? So that's how open market operations work mechanically. Now, obviously, like this is also a very interesting area, which I definitely think is really interesting. Open market operations really are carried out by traders. You know, they're actual traders that the Fed themselves employ. Um, I would recommend one of these people. This picture is actually from a guy called Joseph Wang. He wrote a book called Central Bank 101, which I think is a great book. And there's other books which I recommend as well for these topics. Um, but he explained he used to work as a on the trading desk at the Fed, which basically means that he used to carry out open market operations. And there's multiple traders at these desks who basically their whole job is to uh, sell or buy up securities or sell securities, depending on what the Fed is trying to do, but buy it and sell securities to primary dealers who have a Fed account. And why? And you might be saying like, you know, why is this so complicated? Why can't they just like give why can't they just sell it? The reality is, right? It is a market. People try front running. If they know that the Fed is carrying out open market operations, what would a trader do? They're gonna bid it up. They're gonna bid up the price. They're gonna bid up the price so that the Fed has to pay more. They'll try front running the trade, right? So that's not a good thing. So the Fed has to do it discreetly. They have to do it in like a very like secretive way. So they have to carry out intelligence. So like basically these traders they have direct access to a bunch of primary dealers and like other people for information. So they basically conduct like surveys and talk to a bunch of and interviews and stuff. So they go around talking to a bunch of people. They're like, oh yeah, what is your market view and stuff like that. And when they carry out open market operations, they have to do it very discreetly. And they have to do it directly with primary dealers and stuff like this. All these things. So this is injecting liquidity directly into the market for assets. Um, and this also juices the economy in the same way. But the problem is, um, again, you always want to know this. You always want to make sure you understand this. There are only four apples, right? There are only four apples, right? So no matter how much liquidity the Fed injects into the market, there's only four apples, right? So what the Fed really is trying to do is they're trying to boost the economy, or basically trying to say to traders that there's an opportunity here. Please come in, right? Take risks. We're giving you money to take risks because we need you to take risks to get out of this economic slump, right? And this is uh there's this guy actually. It's a very he's not a very like I don't think this guy is like a good like I'm sure a lot of people have heard of like Rich Dad Poor Dad. It's just like one guy, Robert Kiyosaki, who basically wrote this book. He's like a scammer. I wouldn't really recommend like listening to him and stuff, but like uh I wouldn't say he's like a scammer, but he basically sells courses, right? I haven't read this book or anything, but I've seen like a few clips about what he says, and some of what he says is kind of true. So you definitely need to think about that. Um, but essentially, like this is like when I was like 15 or whatever, I saw this guy on YouTube and I was like, wow, that's kind of interesting. I don't really understand what he said. I never read this book. I just saw him on YouTube. And he's like a course seller. He's not really like a very like trustworthy guy for information. But he used to say one thing. He would say, what did he say? He said like debt is good or like some shit like that. Um, uh, Okay, so I don't know. He says some like cringe quotes like "good debt makes you rich, bad debt makes you poor." But generally speaking, what he's a real estate investor, and what the general idea is, right? When the Fed carries out, this is like the overarching picture that I want you guys to understand. Like, obviously we think about the micro stuff and like the things, and we don't really think about the purpose. The Fed really just wants to carry out its dual mandate. And in like an economy, let's just say like COVID-19, everything is shutting down, everything is like going bad and stuff. The Fed basically wants you to take risks, right? And the people who take risk, the Fed is basically saying, if you take risk, you'll probably get paid out a lot of money, right? So in direct terms, and I think he framed it really in a really nice way. He basically said that uh, right? I mean, he didn't say this, but this is kind of like I'm summarizing the exact idea. When Fed carries out open market operations or they're dropping interest rates to zero, they're basically giving money to people who already have a cushion or who already have existing money or who are willing to take risks and basically telling them, yo, I'm going to give you this free money, go invest it. You can make some money off of it, but that will help the economy go up, right? Because guess what? When this guy goes out and buys real estate, or he goes out and invests in businesses, or he goes out and starts his own business, he's taking a risk, right? But because of that risk, right, he now has this money that he took a loan out for, and he's employing a bunch of people. When he employs a bunch of people, unemployment goes down, and that helps the economy, and that helps GDP, right? So the Fed directly is giving you money for free and saying, "Go gamble with it," right? Because we need you to do these things so that the economy goes up. That's kind of the way you think about open market operations and QE and all these things. However, I think it's worth mentioning that these things disproportionately benefit the rich, um, and through a number of ways, right? So we should definitely talk about those things as well. There's something called the Cantillon effect or Cantillon effect. I don't really know how to say it, but Cantillon effect, right? Uh, is basically what this basically is that the people who are closest to the money source or the source of the money printing get benefit first. How do I explain? It's basically like what is inflation, right? Here in this scenario, I basically omitted a very key detail in this four apple scenario, right? I said four apples, $4. Each apple is worth $1, correct? But what if, well, but when the government prints more money, right? So they increase the supply of this, they increase the supply of this, right? A bunch of money flows into the system and it causes inflation. So the apples go from being worth $1 to being worth $2. But how does that happen? We need to think about the dynamics of like how that exactly happens. Like, does it just magically happen? Oh, I sense $2 more in the economy, so the apples were $2. No, it happens through a traditional market-based system in supply demand. What does that really mean? That basically means that let's just say the Fed prints a bunch of money and keeps it under their bed. Will that change the price of apples? No. It only happens when they buy up apples, right? Like, okay, I guess let me try it again. Four apples, $4. Each apple is worth $1. Okay. But instead of $4, let's just say there was $8 or $100, right? Does that automatically increase the price of apples? No. It's only when those dollars are spent to buy up apples that the apples price increase. So what that means is, let's just say the Fed prints an extra $4, right? The first person, let's say, who gets access to that $4 and spends it to buy apples is causing inflation, if that makes sense, right? Because for like an extra $4 automatically doesn't increase the price of apples, right? Let's just say there's an extra $4 that the Fed prints, and I take it and I put it under my bed. I never buy any apples. Does that change the price of apples? No, it doesn't change anything. But let's just say I get those first new freshly printed $4 and I immediately buy apples, right? and I'm causing inflation of those apples. I'm causing the price to increase, right? But here's the crucial part. When I first bought those apples with my newly freshly printed $4, I bought them at $1, right? I bought them at $1 and now the price is $2 after inflation. So I benefited first. I just got free money, right? I just got free money from the Fed and I basically bought up apples at $1 and then everyone else experiences the inflation that everyone talks about, right? And there's a famous there's a very good quote for this. It's called dollar inflation is global taxation because dollar is the reserve currency. The more you inflate the dollar, everyone who's far away from the money printer is getting essentially taxed. They're getting taxed because they're far away from the money printer. Similarly, when not super conspiracy, but let's put it this way, right? Again, through the same example, interest rates and quantitative easing. We already talked about how these things enter the market through the IORB and open market operations, which are through buying up treasury securities uh, through primary dealers. Let me just write that down. Treasuries and MBS from primary dealers, I believe. This is kind of yeah. So buying up treasuries and MBS from primary dealers. Uh, Yeah, so these are the two ways. But let's just say the Fed decides to buy up treasuries from, let's just say they're engaging in quantitative easing and they're buying up treasuries and MBS from primary dealers, right? So they just bought a bunch of treasuries and they gave a bunch of money to, let's just say JP Morgan. Now, JP Morgan immediately lends this money out. The first guy who gets that money on his hands, like the first guy who asks for a loan and gets that money and spends it, is causing inflation. And but the thing is, he's buying it at a low price, and that's kind of how this guy became rich. The moment he basically, I mean, I don't really know exactly, but he basically explains this, and I think it's a really good concept to understand how this works. Um, but basically, what he's saying is like when the Fed decreases interest rates or engages in open market operations, you need to be the guy who has a safety cushion. You need to be the guy who has money. You need to be the guy who is not affected by a bad economy. Because the Fed only engages in these things to solve the dual mandate, right? Like, think about that first. The Fed is only decreasing interest rates or engaging in OMO to for decreasing interest rates, they're trying to decrease unemployment or increase the employment in the economy. Basically, they only decrease interest rates when the economy is bad, right? When the economy is bad, everyone's suffering. So if you're the one guy who's not suffering when the economy is bad, you can make a lot of money. Is basically what he's saying. That's TLDR. If everyone in the economy is suffering, but you're the one guy who's not suffering, the Fed is basically saying, I know you're not suffering because you made some like good financial decisions and you have a bunch of money. This is the time to take a bunch of risks, right? I'm giving you money for free. Go out and invest it and you'll make a bunch of money. That's what the Fed is basically saying. Essentially, that's what this is, right? And this guy basically, what he would do is he would wait for. I mean, I don't know. This is not his primary strategy, obviously, but I'm just saying this is a general idea. Um, let's just say he would have a bunch of money if you have a bunch of he would have a bunch of money during like a bad economic time and then he would get a loan from when the economy crashes he would get a loan from the government at really low interest rates, immediately use that to buy up assets, and his act of buying, not just him, obviously a bunch of people, this is a huge economy, right? So obviously think about that, but like, his act of buying a bunch of assets will cause inflation, but it will also cause lower unemployment because him investing in businesses, him buying up real estate, these things add to job growth. So he's helping job growth, but he's causing inflation. And the thing is, he gets to get assets before they inflate, before the inflation happens, right? He bought it when the apple was $1, and now the apples were $2 after he finished buying it. And this is what we call the Cantillon effect, right? In simpler terms, people closer to money printer make hella bank. That's basically the idea, right? Okay, so that's that. I think, I mean, there's obviously like a lot of things I could talk about. I think I already talked hella about this. Maybe I'll go back and come back to this if I, have time. I do want to talk about one thing. I'm trying to think if I should talk about this really quickly. I'll talk about this. Here's what I talk about. I said the Fed is a lender of last resort, right? Um, but so usually when a bank runs into a liquidity crunch, right here, a bank assets need to be converted to dollar, right? So when like a bank runs into this, right, they basically will go to other banks, right, and stuff like that, um, usually. And if they can't go to other banks because other banks don't want to give you money or other banks are in trouble as well, let's just say there's a really bad economic event that every bank is down, right? Every bank is going down. That would be sort of that. So like no banks can lend to each other. The Fed has to step in. This is kind of what happened in COVID-19, right? In March of 2020 or 2022, I think it's 2020. March of 2020, basically, there was a huge problem because like people thought the Treasury bonds were super liquid, but they weren't because all banks were suffering because of the COVID-19 pandemic. So the Fed had to step in and provide liquidity, and they made something called a standing repo facility. Um, I guess this might be going into too much detail, but I think I can talk more about this later. But there's something called the standing repo facility. I think we'll talk about this later. There's a standing repo and the reverse repo. Reverse repo. I guess I'll talk about this later. It's fine. These two talk later. Okay. But these are basically vehicles in which you provide liquidity to people, but it's not exactly QE, but it is kind of QE. Complicated. We'll talk about that later. Let me get OCD. Just like fix this real quick. I messed this up so bad. Yeah. Cool, 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 cool. Okay. So, anyways, this is how they carry out their dual mandate. This is how their dual mandate works. I think I talk about liquidity, I talk about dual mandate. I didn't talk about standing repo facility. We'll talk about that later. We're talking about the two-tier system. We talked about what money is. We talked about the gold standard, Bretton Woods systems. We talked about inflation, Cantillon effect. We talked about liquidity crunches, Fed account, ladder of last resort, QE, FOMO. We talked about the velocity of money. Uh, we talked about this. Talk about asset liabilities. Side note: if you're into business and stuff, there's three things that you should learn, which is the cash flow statement, uh, income statement, balance sheet. So these things you should be able to like understand them very clearly because they'll help you understand how these things work as well. In this case, like a lot of accounting tricks happen inside banks. Like the loans are assets, these are liabilities, but then they have equity here and stuff like that. So you want to really understand these things very clearly if you want to understand all this. If I get a lot of traction or something, I can come back to this later. But this is the basic idea. Um, we talk about treasury bonds and yield curves. Um, Okay, so let's talk about HFT. Okay, I put HFT here, but these two are basically I'm trying to talk about the same thing. Um, these are generally hedge funds, right? Hedge funds slash speculators uh, slash liquidity providers, LPs, I'll say, right? What are these funds, right? Where do they sort of fit in to this sort of economic system? Okay. Um, okay. Now let's talk about the other side of economics, which is price discovery, capital allocation, capital formation, and why these things are extremely important for a robust economy and an overall financial system that provides a huge moat that a lot of other countries don't have, and they suffer because of it. You know, one of my key things that I never understood, and I still don't fully understand it, is I'm like an immigrant and stuff like that, but like generally speaking, a country like China, for example, right? You would think a country like China would be much stronger than the United States because they have hard assets. They have rare earths. They have solar. You know, uh, they have goods and services. They make real things. Like from a traditional, like very simplistic standpoint, you would think these things are valuable. Like oh, a shoe, like that's useful. You know what I mean? Like making a shoe, that's not easy. It's not hard. It's not trivial. Like that's useful, right? Or having hard things like that's useful, but I think it's not exactly explained what the vote of the United States is, or why the U.S. is really at the global leader, or why exactly the U.S. is like so high up. These things, and I think one of the huge moats that the U.S. has is their financial infrastructure. What does that really mean? How do markets work? How do they function? What is a capital market? What is its purpose? Who are market participants? And how do they all act? So this is the part two. I say part two, right? Okay, let's start with the NYSE, New York Stock Exchange. It's an exchange. What's an exchange? I give dollars, I buy stock. Really, that's really just it, right? Going back to the balance sheet, I think most people understand this pretty clearly. A company will have a balance sheet in terms of assets, liabilities, and then they have like equity and stuff. A part of that equity, they basically convert it into stock and they give it to other people, investors. Usually, a company goes through a private funding process, especially if they're a startup. They raise funding from investors. They get they go through their Series A, Series B. They go through C, Series A, Series B, all the way, and then they eventually IPO. And an IPO, I'm gonna write that down. Initial public offering. And what an IPO essentially is that they're basically giving the market access to their shares or their stock of their company, uh, and, uh, uh, and yeah. So let's start off with that. Why will a company IPO? Okay, why does a company IPO? A company IPOs for capital, right? They want money to fund their business. Let's just say you're Google and you're trying to scale. You're trying to acquire your next billion customers. You're trying to scale up your you're trying to scale up your data centers and other capital expenditures, whatever your capexes are. Where do you get this money from? Right? Sure, you could go up to Saudi Aramco and ask them to give you $1 billion. Maybe you could go to private investors and ask them to give you 10 billion. Obviously, in the modern like private equity, it's not private equity, like venture capital industry, there's so much money in there that you could probably fund them. But usually, if you want to raise in the order of tens of billions of dollars, you would go to the public market. You and me, regular people, pension funds, all these people are willing to give you money, and you would go to the public market to do so. And this is what we call an initial public offering, an IPO, right? And this is crucial because every company needs money. Every company needs money to operate, to cover their OPEX, CAPEX, and all these things, so that they can scale and then they can, become big companies, huge companies, whatever. So this is really important for capital formation. And the New York Stock Exchange essentially allows for capital formation, right? They give each participant a stock of that company, and that the money goes directly to the people who own the stock, which is the company itself, and they can use that money for whatever purpose they need, right? So this capital formation is really crucial for businesses to operate because businesses need money, right? You know, yeah. So the basic idea, right? So you okay? So all good till now. Where do these speculators, HFTs, hedge funds, where do they come from? What are they doing in this, right? And I think this term hedge fund is a very loose term. You know, it doesn't really explain what type of thing that they are trying to do, right? So let's qualify or quantify this actually. So we talk about markets. These are markets. You know, this is kind of a bit aspect. I'll come to this, but we need to talk about. So in a market, there are multiple market participants. And this is crucial to understand because you need to know you kind of need to know like what people are sort of uh in the market for, right? Just like, you know, if you go to like a real market, like a, I don't know, like a farm, like a market for like vegetables and stuff like that. You know, usually you go to like buy vegetables, but there could be some people who want to buy it and resell it, or there could be some people who want to like hoard it or something. There, you know, there's usually market like different people over there, right? Um, okay, so here's what you need to understand. There's investors and traders. Okay, so these are going to be pension funds, hedge funds, etc. Um, I mean, I guess it's kind of I wouldn't say traders. Okay, I'll just say like hmm. Yeah, okay. I'll say investors. So investors are gonna be like pension funds, sort of like other like other like sovereign wealth funds, sovereign funds. Uh, you know, basically these are people who are holding, looking to like buy and hold for a long time. Essentially, these are general investors, right? These could be like bigger banks who are looking to buy up assets, insurance funds, whatever. This could be a lot of things. Okay. Then you have your speculators. These are basically like hedge funds, not again loose term, but and maybe some retail traders who basically have a thesis, right? Traditionally, a much more short term thesis um, of why a stock or equity or whatever like will go up or down in a much more short term time horizon, and they will take some risk for that, right? So those are like the things, right? Okay, cool. Now we have what we call market makers and dealers, right? These are what we call liquidity providers, and I'll get to that on what that is and you know how that works and stuff. Then we have like the brokers, which is NYSE a broker? I think NYSE might be a broker. Is NYSE a broker? I think they are. No, they're the Securities Exchange. They're a marketplace. I see. I see. Let's see. I see. Okay. So a broker would be like a person who trades on New York Stock Exchange. An exchange is like a marketplace. But you need access to that marketplace, and your access is through a broker. And you have like and these are very and you have regulators. Regulators being the Fed itself and other government like entities, right? Gov like entities. Okay, I'll explain all these things. By the way, you probably can't read any of this, but yeah, whatever. Uh, yeah, sorry. Anyways, so you have all these market participants. What do they contribute to the market? Right? What is the point of just buying and trading and selling and what is the point of all this? At the end of the day, what did I say here? The goal of a market, right, at the end of the day, is for capital formation, right? It's for capital allocation and capital formation, right? But guess what? How do you allocate capital? Okay, that's a great question. If I have $1 billion, do I just give it to some random guy on the street, or do I give it to a company that I know is going to make profits, right? And that capital allocation is very important. Basically, we want to give the best companies more money, essentially. We want to give the best companies more capital and the not so great companies less capital, right? So, all these people, right, the goal of most of them, most not all, is to engage uh, in what we call price discovery. Essentially, we need to figure out how much capital we are giving to a company. Now, obviously, I know people come and talk to me about like derivatives, oh, derivatives are used for hedging and they like produce volatility, whatever. I understand all that. The general purpose of a market is for capital formation allocation, right? Cool. Um, we can also talk about why derivatives exist and because they're not even used for capital formation allocation. Like, why are they useful? Yeah, we can talk about that. But generally speaking, that's the purpose of the market, right? Um, yeah. So, that being the case, these are the market participants. I think the pension funds and the sovereign funds are very easy to explain. They just buy and hold, and they basically have a general thesis. They think that this is a long-term stock, and they think they do their own little thing, but they have their goal is to provide relatively safe yield. Uh, they don't want to like they're not going to YOLO their savings or whatever because they're representing their entire like country. So, they usually do like safe investments like in treasury bonds or tips or whatever. Like, all these other securities are relatively more safe. Okay, now we have speculators, retail traders, hedge funds. Retail traders, obviously, we know they just want to make a short term money. So they just go have maybe some of them have a slight thesis, but, they just throw money around. A hedge fund might have a much more sophisticated thesis based off of some sort of like rigorous statistical like analysis, like arbitrage. Uh, yeah, there's many market opportunities in edge, uh, but they basically try to engage in the price formation, capital formation process by making sure that yeah, just arbitrage opportunities and other things that maybe the market doesn't consider don't exist, right? And they make a profit off of that, and they help the market by being more sort of allocating capital better, right? So we think of hedge funds as like these, like I don't know, like evil entities or something. I mean, at the end of the day, like their main uh, uh, the problem with these entities is that their stated goal is never going to be, oh, we want to help allocate capital to the best companies in the marketplace so that they could use that money for good deeds and then promote the overall economy. That's never gonna be their mission statement. Their mission statement is to make bank, right? So obviously it's an easy target for regular people to be like, oh, they're evil because they just do stuff and they make money and they don't serve a very clear purpose or usefulness that many people can perceive. But I'm trying to explain the usefulness here of generally why they exist. At the end of the day, any participant in the market that helps in the process of price formation or sort of capital formation for like businesses uh, are doing generally a good thing, right? Now, uh, you know, obviously, if you're like doing illegal activities or sort of manipulating the market or engaging in some sort of like illegal trading or something, wash trading. That's obviously bad. Not advocating for that. But generally speaking, like when you engage in the process of capital formation, like through price discovery, that's a good thing, right? Yeah. Okay. Let's talk about market makers and dealers. I think this is where it gets interesting, right? These are traditionally what we call HFTs, high frequency trading. Uh, I think a lot of them probably are also doing some sort of arbitrage and stuff like that. But generally speaking, they are not. They are predominantly, from what I understand, they're doing market making. and liquidity provisioning. What does that mean? Liquidity provisioning. It sounds very like whatever. What does that really mean? Okay, so let's talk about that. When I see the price of, let's just say, Bitcoin or any other asset for that matter, right? But let's just say it's at $100,000, right? What does that really mean? That basically means that I could go in the market and buy for $100,000, right? Cool. But here's the issue. To go into the market and buy for 100,000, someone needs to sell it to you. Now I know the fair value is 100,000, but like someone needs to sell it right now. What if there is no one right now? And the simple analogy of what I would how I would think about this is let me see. Uh okay, here's a great example. Uh wheat or tomatoes or like I guess eggs. What are the prices? Egg prices. Much better. Okay, let's just say eggs are like $7 or something. I don't really know, but like whatever. Okay, let's just say eggs are $7, right? Um, if eggs are $7, it's $7. It's worth $7, right? But where do you get eggs from, right? You need someone to sell it to you for $7. So you go to market, a market being like it could be something like generally speaking, you would probably go to like a store, like a grocery store. It's not exactly a market, uh, but kind of, right? I would explain. This is how I would define it. If there's an egg market, right? If we characterize the egg market as like a traditional market, then the grocery store would be the high frequency trading firm, or the grocery store would be the market maker. What do I mean by that? I mean, I guess I don't know about high frequency trading firm, but like, I would say like they're the market making firm. What I mean by that is at all times to trade a security, you need someone on the other side of that trade sitting and waiting for you to come in. You need someone to take the other side of the trade at all times. Or else you would be waiting or you would take a really bad trade. You have a lot of slippage, right? What does that mean? So let's just say that the price of eggs is $7, but you cannot find anyone to sell it to you right now. Like you just don't have anyone to sell it to you right now, right? Like for some reason, whatever reason, right? Maybe uh, stores are closed, right? They're only gonna open tomorrow, but you need eggs right now, right? So you're willing to pay $10 for it. You're willing to pay $15 for it. At some price, someone's gonna come in. Someone who holds eggs. For example, let's just say I'm a regular person. Let's just say I'm your neighbor, right? You really want eggs. I'm your neighbor. I have eggs at home. Okay. You really want eggs. You go to the store's closed. Usually eggs are $7. The store is closed. You go to another store, they're all closed. But you really need eggs. You know eggs are $7, but you need it today. All stores are closed. So you start asking people, I want to buy eggs, right? And you're like, oh, I'll pay $9. I'll pay $10, right? Now I'm your neighbor. I'm sitting at home and I have eggs. So I give it to you for $10, right? So you just paid me $3 more. You paid me $3 extra, but the eggs are still costing $7 only, right? So you just executed what we would call slippage, because there was no market maker. There was no person sitting and waiting for you to come in and buy those eggs. Or there's no person waiting for you to come in and buy eggs, right? You just had massive slippage. So the goal of a market maker is basically to provide liquidity to financial equities and products so that people can execute trades with the least amount of slippage. That's basically the goal of well, that's not exactly their stated goal, but that's the service they provide essentially. Liquidity provisioning, right? If that didn't make any sense, let me try explaining it one last time. When you go and you want to buy Intel stock or Meta stock, right? Or let's just say Google stock for the simplicity. You want to go buy Google stock. Google trading at, let's just say some number, $100. Um, you need someone else to take that trade. That someone else is going to be a market maker. If those market makers don't exist, you would have to keep bidding lower, higher and higher. So at some point you would say like, oh, I'll take it for like $110, and someone will come in who is like not a market maker, or you have to wait a long time. So basically, market makers essentially make markets fluid, and they reduce the bid ask spread, as you can see on the screen. Um, that's their service essentially. When you come in and trade, it's like fast and easy and low fees and quick and stuff like that. That's the service they provide. And this is called market making. And the goal of a market maker is to reduce the bid ask spread. Well, not exactly reduce the bid ask spread, it's just to be well, okay. Let's let's back it up here. Traditionally speaking, no market maker or any firm is going to come out to you and say, our stated goal is to make it easier for people to trade. Their goal is to make money. It just so happens that in a capitalist system, sort of like an exchange, it just so happens that when you seek out your own goals of making maximum money, you're also providing a service that's pretty darn useful for other people, right? So, uh, in terms of market microstructure, I can explain this real quick. This is what we call the order book. I guess this is not exactly the best order book. I can show you a really good one on. I'm just gonna hide the little the little order book. It's easy to see. If I can find it. Okay, so let's just put this over here. So this is what we call an order book, right? You usually see the charts, like the charts going up and down, but the chart is just showing price action, right? The chart just shows price action. It doesn't really show the liquidity that exists at the market at the current time period. And I think this is really crucial for people to understand. So let's really talk about this. We're going to talk about this and what all this is, right? So let's talk about that. The price, and this is Intel stock. This is Intel. Price of Intel stock, according to the order book, is somewhere around 48.091 and 48.097. That's basically the price of Intel. Right? So it's about 48. Let's just say 48. So what that necessarily what that means is this is what we call the bid ask spread. Uh, and these are asks, I think, and these are bids. What does that mean? Basically, when I want to buy Intel, let's just say I want to buy Intel, right? I want to buy. Oh, wait. Okay, yeah. This is right. So when I buy Intel, I want to buy it at the highest price possible, right? I'm going to quote the highest price. And the highest price is 48.091, right? When I'm selling Intel, I want to sell it for, wait, hold on. No. Invert that. When I'm buying it, I want to buy it for so this is actually, am I tripping here? Invert that. This is gonna be, I think, this is gonna be the asks. Hold on. Let me just check. Let me just make sure I'm like explaining this correctly. Why stupid? So like, I mean, I get. Yeah, I'm right. This is right. I just explained it wrong. Okay. Cool. So this is definitely the bid. It's definitely that. So when I'm selling something, I want to sell it for the lowest price possible, right? And that's gonna be this price. Sorry, what am I saying? Whoa, I'm actually tripping completely. Hold on. When I'm selling something, so when I make a bid, right? I want to sell Intel. I want to sell it for the maximum price possible so I can make the maximum money, which is 48. Okay, this number. When I'm buying Intel, I want to buy it for the cheapest price possible. Okay, I want to buy it for the cheapest price, and that's this number. Okay, so that's that. Right, so that's the order book, and all these bars over here, the bars you see here, these are the liquidity at each level. Right? So at this price level, at 48.091, 48.097, there's basically no liquidity there. No one's willing to basically do that trade. But if you go all the way down here, 48.032, 48.153, you have some size, right? You have a lot of people who are willing to trade there, right? So these are what we call resting orders, okay? This basically means that these orders exist on the order book, and these are all market makers. These are all market participants who are market makers. They're making the market by putting an order out there, a resting order, right? So they're putting a resting order out here. And what happens now is that when, let's just say I want to go buy Intel now, what I am when I buy Intel, just like I just go in and I want to buy it, I am a market taker, right? Why am I a market taker? I am taking liquidity off the order book, right? And that's why there's a fee, because I'm taking money off the order book instead of providing liquidity. I'm taking money off the order book. I'm a market taker because of that, right? This is why I get fees and stuff like that, right? So let's just say I want to buy Intel, and obviously when I buy Intel, I want to buy for sort of the lowest price possible, and like I can, I kind of see that the lowest price is like, somewhere here. You know what I mean? Like it's somewhere here. So the routing, sort of the exchange is automatically gonna hit one of these, right? So like I can buy this. Um, so that's taking liquidity off the order book. One sec. Okay, so the bar over here just goes down a little bit because the liquidity has been taken off because I basically filled that order, right? Um, so I'm a market taker and I have to pay fees for that. And the market maker basically gets a small fee. Usually, the market there's a maker taker model usually in most exchanges, but they get a small fee basically for providing liquidity, for making it easier for me to come in and buy it. Because if they weren't there, if they weren't sitting here, if all this liquidity didn't exist, if all this basically did not exist, when I came in, I could not have bought that quickly. I couldn't have bought at this price. I couldn't have just bought quickly. There's no one waiting for me. There's no one waiting just for me to like come in and buy. Right? There was no grocery store, simply put. Right? So they get a small fee for that, essentially. So that's the idea of a market maker and HFTs. HFT firms basically try to do this at like a really fast scale. So they have FPGA engineers and stuff like that. They have like a very sophisticated algorithm to basically quote prices. Essentially, this is as a side note, the spread is basically just showing you the certainty of the market. Basically, they certainty meaning like how certain they are that this is the fair value price of this asset at this time. The market makers really take obviously I'm not trying to be like glazing or whatever. The market makers do take some risk, specifically because like let's just because they're putting their resting orders out here. They all know. I already know what their orders are. I know that these people are going to be willing to fill it on this, so I already know their hand. It's like in a poker hand, except I know your hand, right? So the issue with that is, let's just say I know something that most people don't. Let's just say I know Intel's about to crash, right? I know, like, because let's just have insider information, or I just know something's about to happen, or I know like AMD or Nvidia or Google. I know Google's about to crash for some reason, right? I can kind of go in and then buy it up because I know it's about to crash. I know these prices that they're offering are like really cheap, right? So I would go in and buy up all this liquidity in this order book because I know it's about to crash. And then 5 seconds later, it's all crashed, right? And then the people who lost a lot of money are actually the market makers. The market makers got screwed. They got screwed because I just came in because I had some insider information. I just bought up all these assets, and the market makers are just left with nothing. And then they just lost a bunch of money, right? So yeah, that's there's a name for that. It's called this is again, this is kind of a side note and like a little tangent, which I probably don't want to go into. Um, I guess I already talked about this, so I guess I could go into this. I didn't talk about derivatives, I guess. Um, but okay. Well, I guess we'll talk about this. So, it's called what is it called? Let's see. I forgot what it's called. Adverse selection. There we go. It's called adverse selection. Basically, what this basically means is that let me write this down. Uh, Adverse selection. What this basically means is that a person who's running who's a liquidity provider, if the other side of that trader, like if the trader on the other side is extremely sophisticated or extremely smart, they're gonna get picked off because the liquidity providers have to show their hand. They have to show their poker hand, kind of like if you think of it in poker terms, they have to show their hand. So because they have all these orders, they have resting orders. They put everything out there, right? Since they put everything out there, they're subject to adverse selection. What that basically means is that someone who's smart, right, knows these prices are cheap, they'll just come and buy everything up, and then the price crashes 10 minutes later, and then the liquidity providers just get screwed. All their liquidity, like all the money that they put in, they just lost all of it, right? So, there's an adverse selection problem, and that's why. Again, this is a little side note, but Robinhood, if you guys know that platform, uh, um, I think this is very well covered by most people about how Robinhood operates as a broker. They have Robin Securities, which routes the orders basically, but they use something called PFOF or Payment for Order Flow, right? And they're using Payment for Order Flow. What they do is retail traders basically go in. Retail traders are market takers. Market takers, right? They go in and then they'll basically buy. The other side of that, basically, Robinhood will write all like the orders directly to Citadel Securities, or Citadel Securities, I think. I don't really know. And Citadel will basically make a market for them. They basically do the market making. Who engage in market making? Market making. And now, in this model, right, generally speaking, when you have a full on NYSE exchange style broker system, you'd have multiple market makers and you would trade alongside other traders. Like it would not just be retail traders, it'd be institutional traders, you don't really know who you're trading against. Right. So a general market maker has to be aware of adverse selection because they could be trading against the most sophisticated guy in Wall Street, or they could be trading against a guy in Wall Street bets or some other degen trader, right? So you don't really know. But in a payment for order flow system, Robinhood directly routes orders to Citadel. So you kind of know who you're trading against. You know that you're trading against Robinhood traders. And you know there's no institutional capital here. Um, and so what that really means is you quasi eliminate the adverse selection problem. From Citadel's perspective, they know that the guys in retail don't know shit. Like they have no other information, or they're never going to get picked off by retail. So Citadel's perfectly fine making a market for them because they know that they're never going to get picked off, right? Because they will never fall victim to the adverse selection problem. Um, but yeah, so that's kind of how that works. To be fair to like Robinhood and Citadel, I'm not necessarily sure this is a bad thing for retail. It's not like Citadel is making money off of. I mean, they are making money, but they're not making money off of like betting against retail traders. They're just running a market for them, but they're hedging their bets completely. So they're not like kind of like making money when you lose money. They make money regardless of when you make money or lose money. That's their whole purpose. So they only try to eliminate the adverse selection problem. I'm not necessarily sure if they lose money from that. So that's something I would be, sure about. Anyways, okay, so that's that. Uh, Brokers. We just talked about brokers. I guess we covered that. Yeah, and then we can. I guess we can talk about regulators. Um, I'm actually not fully sure about how. I guess we talked about it. Regulators, in the sense that in a market they will enter and do open market operations. So the regulation I'm talking about is basically the Fed doing open market operations. They enter the market, they buy up mortgage-backed securities, they buy up treasuries and stuff, and they have to do it in a discreet way so that they don't get front run. Because the Fed is basically a huge buyer, and they're going to buy in huge quantities. And if anyone knows that the Fed is going to buy, they're going to like front run that trade with by basically pushing the price up and stuff. So that's kind of how regulators play that. Yeah. So that was that. Okay. I guess we can go to the next topic, which is Bank of Japan. Which I thought, I mean, this is just a very small topic. I just wanted to, I wanted to highlight how other systems kind of work. Simply because, like, it's kind of sometimes you don't understand. You kind of fail to understand how it works because the U.S. is the United States dollar is the reserve currency of the world. Every country in the world uses the U.S. to do trades, to imports, exports, and stuff like that. So it's kind of complicated for us to analyze the U.S. because you don't. You know what I mean, the default risk is very low. The U.S. has like a bunch of different. They have a bunch of different privileges that other countries don't really have. That must be addressed. So I'm taking Japan as a example of how like how this would work and stuff like that. Yeah. So Bank of Japan. What is the yen carry trade? Japan. How much do I want to write? My hands are dry. Let me just drink some water. Okay. Sorry about this. So Japan. Um, I don't know how many people are like super familiar with history and stuff, but back in the day, well, I'm pretty young by the way. If you guys can tell, I'm like 19, right? So I don't really know anything about like history stuff. I've just learned it. Um, uh, Allegedly, in the 2000s, probably in the 1990s ish, uh, the U.S. and other countries basically thought Japan would be number one. They basically viewed Japan to be like the world's like biggest country, whatever, whatever. And they basically thought that Japan would basically rule the world. Uh, and then there was something called the Plaza Accords, which I would say turned everything kind of upside down. Now, I'm not like a history buff. Like, this is maybe I'm oversimplifying it. Anyone who you know thinks it, like is against this idea, I guess you could go down and comment it if you'd like. Uh, but the Plaza Accord, basically, in simple terms, was a G5 agreement. So all the countries came together to depreciate US dollar against Japanese yen and German mark. What does this mean? This basically means, or why did they do this? First, why, then how? Okay. Um, what happened was because the US dollar was the reserve currency of the world, which means everyone tried to get dollars. the value of dollars basically went up. Very, very simple. Everyone tried to, something's very coveted. If everyone wants something, the price of that thing goes up. Similarly, because the dollar was the reserve currency, every country was carrying out trades. Every country was doing stuff, and they all wanted the dollar, so they all bought up the dollar. And because of that, the dollar is overvalued, right? Now, what does that do? If the dollar is overvalued, that will cause a trade deficit. It will cause a trade deficit um, because your sort of exports. I think. Wait, 1 second. I believe exports are expensive. So yeah, basically, when the dollar is overvalued, like people like making something in the U.S. is gonna be like $50, right? And because the price of dollar is so high, like a company, like a Japanese company or something, they're never gonna buy U.S. stuff because U.S. stuff is expensive because the dollar is expensive, right? So no one's gonna buy U.S. stuff. That would be a massive trade deficit, right? Um, which is bad for the U.S. and local industries, right? So what they basically did was the Plaza Accord was basically like, yo, like Japanese yen, low key, like we need to devalue US dollars against Japanese yen so that we could like sell to other countries and stuff like that, right? So they did that. And what did that do? That basically made the Japanese dollar, or sorry, Japanese yen really uh, overvalued, essentially. That's what I think happened. Let me just make sure. Yeah, it forced a rapid, massive appreciation of the Japanese yen against the US dollar, nearly doubling value in over 2 years to correct trade imbalances. How did they do this? They basically, I mean, they just organized in a coalition and then forced each other to do it. And what happened was because this rapid appreciation in the yen happened, it made Japanese goods more expensive, similar to what happened to the US, just too, like, you know, because the US dollar was too expensive, they couldn't export. Similarly, when the Japanese yen became too expensive, they couldn't export, right? Because it's just so expensive. The yen is so expensive. What did this do? It caused a recession in the mid 1980s. Um, and when this recession happened, the Bank of Japan had to do what they call expansionary monetary policies. Um, when we say expansionary monetary policies, the first thing that comes to mind should be this should be this actually should be this. Um, basically, lowering interest rates, QE, all that good stuff. Um, yeah. I'm actually not sure why. Let me just make sure. Mhm. 1 second. Massive interest rate. Okay. Basically, TLDR from, or not TLDR, I guess, but like, what happened was, because trades became more expensive, the Bank of Japan had to engage in expansionary monetary policies, which basically means QE and lowering interest rates. Um, but what happened was they got into it would have kind of they fell into what we call a liquidity trap. Um, it's because let's explain this. Let's explain this in simple terms, right? Japan yen went up in value because of obviously there's like financial mismanagement and a bunch of other things, but like whatever. But we're just glossing over all that. Okay, Japan yen went up because of the Plaza Accords. This made trade expensive, or exports more expensive, which means that less people uh, ask or buy goods from Japan. This caused a severe recession. Okay, to counteract this caused recession. To counteract the recession, BOJ prints money and interest rate to 0.5%, right? So they basically print hella money and then they go interest rate to 0.5%, right? And this causes an asset bubble, okay? Asset bubble pops. Lost ticket. Okay. But here's the problem though. Here's the problem. Acid bubble pops, and you're back into bad economic kind of like not exactly, but bad economic times. Basically, kind of. It's like growth is limited, essentially. Growth is slow and limited, but you have hella assets. So this is more like you're in retirement, right? The growth of Japan is really slow and very, very small, but they have assets because they used to be the king, kind of thing, right? Now you could be asking, like why can't they just, if acid bubble happened, acid bubble popped, why can't they just like stimulate the economy and then just go back? Well, they already did. You cannot decrease rates below 0.0%. Like they were already at 0.5%. They already printed how money. They cannot, the money, like you can't go below that. You know what I mean? They went to 0%. They cannot go below that. And even after doing that, they just couldn't do anything, right? The people just were very risk averse, and they have a demographic problem. They have a demographic problem because well, there are not enough young people to basically work. So this is basically their entire story, right? And what I find very interesting about this is that their interest rate is negative 0.1% or was. Obviously they're hiking or whatever. Like, let's forget about that. But, over the past 10 years, just before 2025, I believe, over the past 10 years, their interest rate was negative 0.1%. Uh, well, let's just say, well, for all intents and purposes, it was 0%. What does that mean? What does that mean, 0% interest rate? It basically means that the bank is paying you literal money. It basically means the bank is actually just paying you money to take out a loan. Like, you know how, like, when you take out a loan, you need to pay the principal and a 5% interest or something? In this case, the bank is just like, yo, just give me the principal, bro. I don't want interest. Like, and in cases, I'll pay you to take out the loan. Why? Because inflation. If inflation is 2%, so this is what you need to understand, real interest rate equals interest rate, minus inflation, right? What does that mean? Like, if let's just say, let me ask you a question. If I just took out a loan and I pay 2% interest on it, but inflation in 1 year is 2%, at the end of the year, the money that I have to pay is 2% depreciated, which means I basically don't have to pay anything. Like, think of it like that. Um, like, let's just say, it's kind of in simple terms, but like, if I took out a 100K loan or something, I got 100K immediately. Um, but when I pay my 100K back, that 100K is worth less, 2% less specifically because of inflation. which means that 2% counteracted the interest that I had to pay. So yeah, TLDR, their real interest rate is interest rate minus inflation, which means if their interest rate is 0%, 0% minus the inflation, let's just say it's like 1%, that means they're paying it's a negative 1%, which means that yeah, whatever. And this led to what we call the yen carry trade. The yen carry trade in simple terms is I borrow money from Japan, at 0% interest, and I invest it in America, right? So I go to Japan, I borrow like $1,000, and then I take that $1,000, and then I put it in U.S. Treasuries, which pay like 3%, right? So now what did I make? I just made 3% kind of risk free question mark? Kind of? Well, not exactly. I mean, it's not exactly risk free. There's a lot of risk. And there's a name for this, for the specific trade, the yen carry trade. It's called uh, um, here's what it's here's what they call it. What can I? Here is what they call it. It's called picking up pennies in front of in front of a steamroller. Because guess what? You seem pretty smart when you're making the money, but you'll get rolled. Rolled by who? This steamroller is Bank of Japan, right? Why does this happen? Well, here's the deal. I borrow money from Japan and I get, let's just say I get 1,000 yen. If I want to invest in America, I have to convert that 1,000 yen to dollars. What does that mean? I am selling yen, right? I'm selling yen. What does that do to yen? Depreciates yen, right? If it depreciates the yen value, what does that do? What does that do for the economy? Makes imports expensive. It makes imports expensive for Japan, right? Which means it's bad politically, which means the Bank of Japan needs to step in. Now, what does the Bank of Japan have to do something about this? They have let me see if I can find the part of this. Well, I mean, I guess. Bum, bum, bum. They have this. They have about one. Well, this chart kind of sucks. Like, well, yeah, this chart is a little terrible. This is not what I wanted to show. Sorry about that. This is what I wanted to show. Okay. If you see closely, they have about, well, I guess you can't see that. No, this. They have about $1.2 trillion in USD. They have 1.2 trillion in USD. What that means is at any time they could sell their US dollar reserves and buy yen. And what does that do? It make yen go up. They can sell dollars and buy yen because if that yen goes up. Very simple, right? And if yen goes up, what happens to you, who basically just sold yen to buy US dollars? You're because now your dollars convert to less yen, you better be making great profits on that investment that you did in America. If you don't, you're getting wiped out. And usually what happens is because you're buying yen and this is such a small trade, like it's only a 3% from 0 to 3% difference, people usually lever up. They lever up 10x, 100x, 1000x on this trade. And so even a 1% move in the yen against the dollar is going to wipe you out completely. And at any time, Japan, to defend its currency, could use its massive $1.2 trillion in reserves to basically sell it and buy yen to defend their currency. And that would basically wipe out these people. So I just thought that was really interesting to talk about. That's a yen carry trade and how Bank of Japan will defend its currency, and that's kind of what they're doing right now. On they're potentially thinking about uh, hiking rates and stuff like that. And Takaichi and I basically came out and said, no, we're going to end the cycle of austerity, and it basically shook up the Japanese bond market completely, which is quite interesting. But yeah, so that's that. Okay, I guess we covered quite a bit. Okay, let's talk about. This is gonna be very very small. I'm gonna not talk about this. I will talk about derivatives and neo finance, but real quick, let's talk about underwriting. And yeah. So what's insurance? Everyone knows insurance. You pay a small premium monthly, and anytime there's a large event in your life that goes bad, you basically get insured against. That's very simple. Whatever. This is a very small topic. I just wanted to talk about how Warren Buffett used insurance to essentially make a bunch of money. What is insurance? Right? Let's just say I'm an insurance company. I am insurance. Yeah, I'm like a corporation. Like, I don't know, like I don't know if this is what like a corporation looks like. Right? You give me money now. So every month you pay me money. Every month I get dollar. Let's just say I get $500. Every month from like how many other people I get $500. And maybe in 10 years I have to pay out some amount of money to basically insure a bunch of people. Right? Cool. Let's just say hypothetically I have the money to insure them. Let's just say I have 1 billion in reserve. Similar to how Japan has reserve money, I have $1 billion in reserve. Okay? In reserve. Right? So in case, let's just say all those 500, like let's just say I have 10 people, right? Let's just say all these 10 people ask for some sort of insurance, like very unlikely, but let's just say it happens. I still have this 1 billion reserve to basically pay them out, which means regulators are off my ass, basically. Are not gonna not gonna like bother me because at no point am I like underinsured. Essentially, I have all the money to pay anyone who sort of asks for it. Okay, so that's that. Okay, cool. So if that's the case, um, these this little $500 payment I get a month, let's just say that accumulates to some amount of money. Like, let's just say this is like a higher number. It's like 5,000. These are like a million people or something. Let's just say the number was like 5 billion. Okay, well, I guess I only have one. Okay, let's say this is 500 million. Okay, 500 million USD. Okay, so it's 500 million USD, which I get in, which people pay right now to insure for a future problem. And the insurance could cost more than, let's just say, it costs like total 3 billion. And I have 3 billion. I have 3 billion in reserves right here. Like I just have it from my other ventures, who knows what ventures, but I have some reserves from other ventures, 3 billion. Uh, and I sort of and because of these because of it, I have these $3 billion, and then I can pay people out whenever they ask me, so it's fine. And now I have $500 million that people just paid me right now in insurance premiums, right? What is what is this money, right? Like, really think about what this money is right now. I just got a bunch of money, right? We know the insurance business already. It's basically that, like, in if like in a million people who pay insurance, only like maybe like 100,000, I don't know, some number, basically a very small number of people ask for the money back. The money back in the sense that they ask for an insurance claim, which means that only a small amount of this money goes back, right? So, but even in that small amount, I basically have $3 billion in reserves to pay people out, even if all of them ask out, just to get the regulators off my ass. So let's just say minus cost. Let's just say usually my model says that of the 1 million people that gave me insurance, only about 100 million people will file for claims. So minus 100 mil, which I just keep in reserves just for fun, whatever. I already have 3 billion, whatever. So I have $400 million, which I know is just which I have right now, which I just have, right? This $400 million is what we call a float. Right? Why is this the float? Like, what does that mean? Usually, what do we say here? We're, a lot like throughout this entire thing, we've been talking about interest rates, 2% interest rates, 3% interest rates. You know, like the lower the interest rates, the better. You know, because for you, you could take more risks and stuff like that. Interest rates are high, it's bad because now you cannot invest and stuff like that, right? This 500 million, people just gave it to me. I have $3 billion over here. What is the interest rate on this $500 million I'm paying? It's 0%. So my cost of capital, as they call it, for this $500 million is zero. I got 500 million right now from all these people, and I have some reserves to basically pay them out if needed. My model tells me that, okay, well, it's not 500, for the 400 million, sorry, for the 400 million. My model tells me that only in a terrible situation, only 100 million will be asked by the people, which means I have $400 million, which I can invest right now. And this $400 million, the cost of capital for this investment is zero, which means I'm not paying any interest on this 400 million, and I got it right away. And this is Buffett's strategy, right? He basically got acquired a bunch of insurance companies, like I think Geico and stuff like that. People would pay for premiums right now, and he would get because from his other ventures he had a bunch of reserves to basically get the regulators off of him, so that he could basically prove that he could pay the people no matter how many of them ask, right? And so whatever money he got from the people right now in terms of premiums was risk was interest free. It was just interest free money, which is the float, which means he could basically use this to invest in stocks, which are high yield. Obviously, there's risk, risk weighted return and stuff like that. But what does the cost of capital mean? Cost of capital basically means, like, a great example of cost of capital is actually well, not a great example, but the U.S. This yen. The cost of capital is so important that even though this is pennies in front of a steamroller, people are willing to do this trade because their cost of capital falls to zero. That's how important cost of capital is. And Buffett had access to this for free through his insurance companies. You know, uh, let me stretch a little bit. Okay, so that's how important cost of capital is, right? Um, and in this case, if you have everything backed, your cost of capital for this 400 million is zero, which means you could invest in a bunch of stocks and equities and whatever you wanted. And because you always have it backed for these people, you could make a bank off of this. And essentially, because your cost of capital is zero, even if you get a 1% yield, you made 1%. For a regular person, let's just say their interest rate for a loan they took is 5%, right? If they made a 1% yield on that 5% interest, then they're at a loss, right? But because your cost of capital is 0% and you made a 1% yield, you're at a profit. So that's how important cost of capital is, because it basically magnifies short, like smaller gains and stuff like that, especially when especially the economy is not doing good and stuff like that. Right? Cool. So that's just a small tangent about underwriting and risk. I already talked about underwriting before, so that's kind of that. Talking about capital allocation, I guess we didn't talk about hedging risk, which is mainly derivatives. I'm sure people know about this, but I believe the derivative market is like versus spot market. If we look at the derivative market versus the spot market in terms of volume, I believe spot market. Uh, well, I guess that's not spot. Like, let's just say equities. Um, okay, so the stock market is about. Okay, this is a little crazy, but I guess it's equities and this thing. Equities market is basically about $900 billion in stocks, basically, and derivatives are estimated to be estimated to be one 1 trillion, 100 trillion, 1 quadrillion in notional value because you get high leverage. Okay. Now I know like people would be like, is there any use for derivatives? Because guess what? I talked about capital formation, capital allocation. Uh, where did I talk about that stuff? I guess I talked about it here. Capital formation, initial public offering, stuff like that, and why they're important. People will probably ask the question, why are derivatives important? Because they don't, they're not useful for capital formation because the money doesn't really go to the people itself, right? This is mainly used for hedging risk, for the purposes of hedging risk. The futures market often acts before the actual underlying. And for gold commodities or sort of like gold futures or um, sort of like for example, like a farmer or something who's working and he's like producing wheat and stuff like that, he can hedge his risk using options and derivatives. And a business, maybe, let's just say a business is scared that the interest rates are going to go down, or maybe their business is going to go down or something. They can hedge that risk. They can hedge that market risk using derivatives, right? And basically, a lot of economists basically came to the conclusion that derivatives actually make markets more efficient. They make the market less volatile because they take risk away from the market, essentially, because they allow for more capital efficiency because you go for like higher leverage and stuff like that. Well, I'm not gonna delve too deep into that because low key I'm getting a little tired. But yeah, it's mainly used for hedging risk, and you can actually search it up. Why you search up like why leverage is more capital efficient and stuff like that. Like just it's interesting. Um, yeah. I guess we can talk about like modern finance or neo finance, which is like crypto and stuff. Crypto usually, again, is a very like notoriously terrible industry that doesn't really like it's not really appealing to the general population because like the meme coins and like this and that, it's like scams and stuff like that. I think just to be clear, I don't really hold I don't have anything to do with crypto. Okay. I learned about it only like a few months ago. Okay. Um, but I don't hold Bitcoin, I don't hold Ethereum, I don't have a crypto wallet, I don't have anything to do with crypto. I don't have anything to sell you. I have nothing to do with crypto. But here's what I need to say, right? From my understanding of what crypto can do and finance in general, I think this is the technology is pretty crazy for what it can do in terms of everything I've talked about till now in terms of markets. Bitcoin itself doesn't really have much value. I mean, when I say much value, I mean like it's just like gold, right? I started all the way here to show that, you know, since the dawn of finance as a whole, it started at gold, it started at, sort of giving this here and then doing that, and then it like changed to fiat, and then it changed to lending protocol, and then it changed to money creation, and then changed to exchanges and high frequency trading and capital formation, capital allocation, insurance. All these things started from gold, sort of like creation of the sort of uh yeah, the sort of creation of money, right? And I think crypto in its industry is sort of in the starting of that, which is Bitcoin is described as like digital gold or whatever. But I think just like how the internet was in the beginning seen as like, oh, it's just like a thing that nobody's gonna use, it's just like scams and like, like nobody's gonna use it, it's just a government thing, right? It seems like this industry has the potential to definitely change a lot of finance in a very meaningful way. And I would definitely be on the lookout for this. And I'm definitely reading and learning more about it. But from what I understand already, I definitely think that we're going to see huge changes in the financial infrastructure for crypto. Um, some I'll go through some of the examples very quickly. Okay, so number one, the idea of an exchange, right? Exchanges right now operate on there's like a broker, there's like a securities dealer, there's like a exchange itself as a marketplace. There's a T+1 settlement. Basically, like after you do a trade, it sells in one day. They have to like issue the stock and all these things. Crypto basically says that, a lot of the exchanges on crypto basically are instant settlement. And once you buy it, you know what you have it. Because it's on the block. It's like a blockchain. It has your transactions record on the block. It happens instantly. Um, right now, mostly in the US, like most of the equities are not accessible to global investors, even though like people abroad would like to get access. You could get access, it's just very hard to do so. Um, so like, let's just say you have Tesla stock or something, like people abroad definitely want to buy it. They just can't buy it, right? So I think there's a huge market there. Making it sort of permissionless and open source, sort of, I think increases the possibility that's like more fair and equitable to more people, which maybe makes it more palatable to more people. And specifically for derivatives, the most interesting things I've seen in crypto through crypto innovation is something called perps, which is sort of like perpetual futures contracts, which is like basically a futures contract, but with no expiration date. I mean, I'm not going to go into the details of explaining how this works. But essentially it works through a funding rate mechanism. And I think this concept of a purpose is just quite crazy. And I think it's definitely going to change finance a lot. Just like how the first derivative was formed and then it has 1 quadrillion in assets. A perp basically allows you not only to have futures on crypto, because most crypto assets are kind of useless. Like, I don't really know what you're trading when you're trading Bitcoin. Like, I don't really understand what you're trading if you just like what are you basing it on, stuff like that. But a perp can trade real world assets. You could have a perp for Intel. You could have a perp for TSMC. You could have a perp for AMD. You could have a perp for Nvidia. and all these assets can be traded on chain as a derivative, which is just kind of crazy. And we're also seeing these like tokenized assets and stuff. I don't really know if they're gonna go anywhere. Uh, but really, I don't. I'm not bullish on cryptocurrencies. I don't really think currencies like Bitcoin and stuff are gonna be pretty huge. Like, I mean they're huge already. Sorry, like what I mean is I don't really see like a huge utility. I guess that would be better. I don't really see utility in BTC. I don't really see utility in all these like random cryptocurrencies, meme coins, NFTs. They don't really have much utility and they're kind of useless. But where I do see utility is in making a crypto exchange. Now, obviously, FTX and things like that collapsed, and that was obviously not good. But I would be watching out for like decentralized exchanges that allow you to trade perps, which can give you exposure to real world assets like actual stocks as derivatives. I think those things could become pretty huge, and they could, quite literally like they could be the next evolution of finance. Uh, uh, but I think the missing piece in crypto is probably that they don't have the stable coins probably backed in USD and stuff like that. They probably need like a stable coin that's like a crypto native stable coin, but obviously this is getting into the weeds. But I would definitely be looking out for it. By no means am I a shill for crypto or like I'm not like talking about that. But I do think right now there are not many people who are actually building in crypto who are like it's more degen traders than actual people who know underlying like code and are programmers that understand the code and stuff like that. But I think there's a huge opportunity there that people definitely need to consider because I think it could genuinely be the next evolution for finance. Um, but yeah, I think that's basically all I have to say. I think we covered most of it, most of everything I wanted to really say. I guess if I have time in the future, I'll come back to talk about like the standing repo facility and the reverse repo facility. I think they're quite interesting. Uh, um, but yeah, I guess that's about it. That's all I wanted to say. If you guys